Good morning. We'd like to call the Investment Committee meeting to order. The first order of business will be to call the roll.
Rob Fechner.
Good morning.
Teresa Taylor.
Here.
Margaret Brown.
Morning.
Henry Jones.
Here.
Fiona Ma.
Here.
Lisa Middleton.
Present.
David Miller.
Here.
Stacy Olivares.
Here.
Irena Ortega.
Here.
Jason Perez. Mona Pascual Rogers. Ramon Rubalcava.
Here.
Betty Yee.
Thank you. Item 2 is the approval of the August 19th committee timed agenda. Any discussion on the agenda? It's been moved by Taylor, seconded by Miller. Any discussion on the motion? Seeing none, all in favor say aye.
Aye.
Opposed, no. Motion carries. Item 3 is the swearing-in ceremony for our new member. Mr. Jones, please.
Thank you, Mr. Chair. Before we get started, I'd like to extend my congratulations to our newest board member, Stacy Olivares. Ms. Olivares was recently appointed by Governor Newsom as an insurance industry representative. She is currently the Chief Investment Officer of Lendtree. As it is customary, we will now have a brief ceremonial swearing in of our new member. Ms. Olivares, would you join me at the mic? Okay, would you please raise your right hand? And I state your name.
I, Stacy Olivares,
Do solemnly swear that I will support and defend the Constitution of the United States
do solemnly swear that I will support and defend the Constitution of the United States
and the Constitution of the State of California
and the Constitution of the State of California
against all enemies, foreign and domestic,
against all enemies, foreign and domestic,
that I will bear true faith and allegiance
that I will bear true faith and allegiance
to the Constitution of the United States and the Constitution of the State of California,
to the Constitution of the United States and the Constitution of the State of California,
that I take this obligation freely
that I take this obligation freely
without a mental reservation or purpose of evasion,
without any mental reservation or purpose of evasion,
and that I will well and faithfully
and that I will well and faithfully
discharge the duties upon which I'm about to enter.
discharge the duties upon which I am about to enter.
Thank you for acknowledging this ceremony. Thank you very much. How about applause? We appreciate your call to service to our 1.9 million members, and our confidence that you will do all you can to represent their best interests. So thank you again.
Thank you, Mr. Jones. Congratulations. Next order of business is Pledge of Allegiance. I've asked Mr. Rubalcava to please lead us in the pledge.
Everybody please join me. Ready, begin.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. Item 5, the executive report for the Chief Executive Officer, Mr. Meng.
Good morning, Mr. Chair, members of the Investment Committee. We have a full agenda this morning. We start with 2 standard recurring items, with item 6 is an consent item, which is to approve the meeting minutes of the Investment Committee on June 17th. Then item 7 covers 5 information consent items. Item 8 is the only action agenda item today, which is to approve the suggested interview process for the board investment consultants and to determine the finalist firms to be interviewed by the subcommittee. Then in agenda item 9, can I have the next page, please? So in 9A, my colleague Eric Bagson, Dan Bienvenu, and John Rossfield will provide you with a trust level review, where we'll provide you with the past investment performance, as well as the current risk positioning of the portfolio, and concluded by an economic update, economic outlook update by John Rossfield. In agenda 9B, where your primary investment consultant Wilshire will provide a performance report, as well as Makeda and Pension Consultant Alliance will provide comments specific to private equity, real assets, and infrastructure. In agenda item 9C, my colleague Kate Crocker and Dan Bienvenu will lead the discussion to seek your review and direction on the proposed update and revision to the investment policy. In agenda item 10, your primary pension consultant, Wilshire, will provide an annual program review of 2 of the total fund level investment programs, which are the trust level portfolio management program and the opportunity strategy program. In agenda item 11, you'll be provided with an annual evaluation of your investment of your investment consultants. So with that, back to you, Mr. Chair.
Thank you. Seeing no other requests, moving on to agenda item 6, the Investment Committee open meeting minutes from June 17th. What's the pleasure of the board committee? Moved by Taylor. Seconded by Jones. Any discussion on the motion? Seeing none, all in favor say aye. Aye. All opposed, no. Motion carries. Item 7, information consent item. I do have a request to remove items 7E and F. So that leaves us A through D. No other request to move those off. So we will go to items 7E and F, and I'm going to call on Ms. Yee.
Thank you, Mr. Chairman. And thank you, Mr. Meng, for introducing the item with respect to the informational item that will follow by the consultants. I thought it may be perhaps appropriate just to have a bit of a discussion on these 2 items. It's the first time I think I recall that these have been put on consent without kind of a public discussion, and rather than hear it for the first time from the consultants, whether we could just have a brief presentation with respect to both of these reviews.
Let me call my colleague Eric Baxton.
Okay, good morning. Eric Baggeson, Managing Investment Director for Trust Level Portfolio Management. Perhaps, Ms. Yee, what I would ask first is if you have any specific questions, or would you just like to cover some of the material in general?
No, just cover some of the material, and I'm mindful of some of my newer colleagues on the board, and I don't remember this being agendized as a consent item in the past, where we've had an opportunity to ask questions as the presentation has been before us.
I don't know, is it possible to load up the PowerPoint that is attached to item 7E? Oh, we are, perfect. Okay, let me step through some of this material, hopefully pretty quickly, and then we can get on to the next segment, which is the opportunistic program review, which I think also you had some questions about. Let's see, I think I'll move past the outline. So first, the Trust Level Portfolio Management Program is basically positioned to be the collection point for almost everything that we talk about when we talk about the total fund. So this area is responsible for moving the strategic asset allocation work that we do with this board. The last iteration of that work was completed at the end of 2017. And over the last year, we've been implementing the structures and the decisions that the board made in relation to that strategic asset allocation work. The other dimension that we are working on is TLPM, or Trust Level Portfolio Management, is also one of the areas where we depend on to try to build a total fund culture and collaboration. So that's one of the primary functions of the entire team that I work with on a daily basis, is to really bring people from across the investment office and across the organization to work on the big questions and the big topics and projects that are of importance to the organization. An example of that is shown in number 2, where we basically work on what we call the ALM process, the Asset Liability Management process. And that is a collaborative effort that goes on and involves the finance office, the actuarial office, the investment office, as well as folks in public affairs to basically bring in external stakeholder communication and perspective into that process. But that's just an example of the kind of collaboration that this team really tries to foster in all of the work that it does. The major accomplishments over the last fiscal year, the primary accomplishment is moving the structure of the asset allocation to what was approved by the board in December of 2017. There were quite a lot of changes that happened in the structure of the investment portfolio. There was almost $150 billion of trading activity that took place over the year of 2018-19, and it has pretty much been completed at this point in time as at the end of the last fiscal year. Our big initiatives for the next coming year really revolve around trying to continue to sort out what we call active risk in the program. And I think that maybe just to help illuminate what we mean by that terminology, active risk, when the board approves the strategic asset allocation, that in essence creates a target allocation to various parts of the marketplace. And those parts of the marketplace are typically proxied by some kind of a benchmark. And that benchmark tends to represent what we think that market opportunity set is. So the very first job of the staff is to basically invest the capital into that market opportunity set. So that's the sort of must-do job for the staff, to basically get the capital deployed into the market as close to what that market opportunity set is. Then, to the extent that you as a board provide some risk tolerance, and risk tolerance can be expressed in a couple of different ways. It is expressed in ranges around the target asset allocation. So, for example, the target allocation to global equity of approximately 50% has a range where the global equity exposure can be as drift through a plus or minus 7% variance from that target allocation. So that range is an expression of a risk tolerance. You also provide a risk tolerance attached to the utilization of leverage. So we'll have some more discussion about that, I think, in the total fund policy later on. But there is some leverage that is provided within the structure of our current policy construct. And the other risk tolerance is around tracking error or tracking variance. So currently, the range of tracking that we are allowed to deviate from the strategic asset allocation is limited to 150 basis points. And that tracking variance and all of these risk tolerances open up the potential for the staff to choose to do something other than perfectly mirror the strategic asset allocation. And the staff should only choose to do something different than mirroring the strategic asset allocation if we have a reasonable belief that by doing so we can improve the outcome to the fund. And that improvement could be represented in higher rates of return, or it could also be represented in basically risk mitigation or lower degrees of volatility. But that's what that risk tolerance gets into. So when we talk about much of the material in both this part of the program and in the trust level review that comes later on in today's agenda, we basically talk about the beta representing the market opportunity set, and then we talk about active risk, which is the utilization of some of that risk tolerance that has been provided by this board in the past. Are there any questions in relation to that? Is that more or less understandable?
I have one question. Ms. Brown?
Well, I had a question about the table on page 12. I don't know if we're going to get to that or if we go to that now. Okay, great. And, we've spent a lot of time, almost my whole term on the board, talking about private equity and private equity returns. And so I see our net return for private equity is listed at 7.7%, but the benchmark return is 4%, and I'm wondering why that is. Am I reading that wrong, or?
Yeah, the benchmark for private equity is basically a benchmark that represents what we consider to be the opportunity cost. And when I say opportunity cost, if we were not deploying capital into private equity, the likely place where that capital would be deployed is into the public equity portfolio. So the benchmark for private equity is linked back to the public equity portfolio plus an incremental margin of 150 basis points of extra return. But that benchmark is also, it's lagged because of the lagged nature of returns to private equity. So what you're seeing is the return that happened on a lagged basis. So the return at the end of the fiscal year really represents the return to both private equity and the public equity benchmark through the end of March of 2019. Does that answer your question, Ms. Brown, on that?
Yeah, it does. I just had a question about that. And then on page 14, what is completion overlay? And it says pilot. I just don't know what that is.
Yeah, page 14 represents the collection of programs that do not fit neatly into any of the existing asset classes, if you will. So trust level portfolio management has become a collection point for a number of different things. What you see in this, for example, we're now in the process of collecting together the emerging manager programs, which is the top line of this chart. So this represents the public equity emerging managers. The external MAC program is the multi-asset class manager program that was originally started by Joe Deere. And trust level portfolio management is basically trying to restructure that program and make it relevant. But the completion overlay is an effort to, in essence, use a derivative overlay to try to represent the entire structure of the asset allocation, but do so in a way that helps us actually manage the liquidity profile of the fund. So that's a program that has been being run in a pilot form. As you see, there's about $500 to $600 million that was deployed in this, so it's relatively de minimis as far as the size of the program. But that completion overlay was exactly that. It's a tool to be used to help us manage the liquidity profile of the fund.
And what manager is running that program?
That's being managed internally. One of the staff members, Todd Eichmann, is the person who's primarily responsible for that.
Thank you.
Ms. Yee.
Thank you, Mr. Chairman. Eric, can we go to slide 13? I did have a question. I think it's something I'm just having a hard time getting my head wrapped around, where you talk about the contributors to the underperformance, the 5-year underperformance, one due to negative contributions from private assets, but then also a second factor was the underweight to private assets, which required substituting public assets. So I guess the question is, if the private asset return contributed to the underperformance, why would an underweight to the same asset class also contribute?
Yeah, so I think, that's an interesting couple of questions. So the private assets create quite a problem in the structure of the asset allocation, in that we have a fixed target to the private assets, and yet we do not have the ability to just push money into or out of the private asset areas. So you inevitably, as the rest of the portfolio bounces around in value, you inevitably have periods of time when you may be overweighted to private assets or periods of time when you would be underweighted to private assets. And those over and underweights then create a performance attribution exposure. So when we're underweight to the private assets, there is, by definition, the equivalent of a proxy. So if the money's not invested, for example, in private equity, like currently, right as of last Friday, our private equity exposure was approximately 7% of the fund. Our target allocation to private equity is 8% of the fund. So we have a 1% underweight to private equity. That underweight, though, is invested in other parts of the portfolio. So it's not money that's just sitting around in cash. What that means is that that money is spread into public equities or fixed income or other parts of the portfolio. So there's, in essence, this defaulted proxy asset. Private equity happens to be our highest expected return asset class. So a systematic underweight to private equity is constantly causing the expectation of a negative performance impact because of that. So,
if I may, there are really two layers to this effect. Your observation is very right. But there are two layers. One is the asset allocation effect. It means that from the total fund level, as Eric just mentioned, that our desired target of private equity is 8%. But we cannot get to 8%, so we're currently at 7%. The 1% underweight to the desired allocation target, because private equity relative to other asset classes is the best performing asset class. So when you underweight to the best performing asset class, so from the asset allocation effect, we take a hit on the performance. And then the second bullet point you see is private equity relative to its own benchmark. That's the second layer. The first layer is allocation to private equity. We under-allocate, we under-invested relative to the target. The second layer is that private equity itself against its benchmark, it underperformed. So that's the second layer. That's where you see negative contribution from underweight. The first point, negative contribution from private assets because private equity underperformed its own benchmark. And then the second bullet point, from the asset allocation perspective, we under-allocated or under-invested to the best performing asset class. So these two both added to our underperformance.
Okay, that's helpful. Thank you.
Thank you.
Ms. Brown.
Sorry, I had one more question about slide 14. Trying to read my own handwriting. We have a category, a program also called absolute return strategies. And is this hedge funds? And if it is, why are we still in them?
Yeah, that's basically the residual of the hedge fund program that's still being worked through on the wind down, Ms. Brown. So that program has been transferred in again to this total fund collection point, if you will. But that's just part of that exposure that still resides and is illiquid, basically. So we're still working down through that.
And we're winding that down soon?
Yes. Well, we'll wind it down as fast as the manager can rationally sell that exposure without taking too much of an economic hit.
Too much of a loss. Okay, thank you.
Ms. Ma.
Nope. I didn't hit anything on purpose.
Okay. Mr. Jones.
Yeah, thank you, Mr. Chair. Eric, you may also comment on the hedge fund, how large it was in terms of your ability to wind down from and indicate what it is right now. That's the first comment, and then I have another question.
Yeah, no, that's Mr. Jones is exactly right. At the time the decision was made to stop participating in the absolute return program, the hedge fund program, that program added up to, I'd have to check the number explicitly, but it was probably $6 or $7 billion, if not even maybe a little bit more in exposure. So there's been a lot of wind down, but this is sort of the stub of the illiquid assets that are left.
And also, if you remember, in the past we talked about these can be part of the legacy asset review.
We're trying to get rid of that.
Yeah.
Thank you.
Okay, thank you. Yeah, my question goes to your comment about the private equity, where you say we were underweight, and you explained the implications of being underweight in private equity. And I think it's important to comment that that wasn't a board decision to be underweight or have fewer resources in this. It's inability to allocate additional funds into private equity. And so as the fund grows, and if you stay at the same amount, the percentage is going to get large, smaller and smaller. So if you can comment on that concept.
Yeah, no, Mr. Jones is exactly right about that. Is with the private assets, if we have a marketplace where the public assets are doing reasonably well, and the public equity portfolio, for example, has done reasonably well over the last few years, and really since the financial crisis, that expansion of value means that you're almost by default going to be underweight to private assets such as real estate and private equity, simply because of that inability to just push money into those asset classes. And on the converse of that, if the market is falling rapidly, you tend to be overweighted to those private assets also, because their value does not tend to decline as rapidly as we've seen, for example, in the public equity portfolio in the past.
Yeah.
So you're absolutely right.
Yeah. And if I may, on that note, as you know, that we have been working very actively to finding all the possible ways to increase our exposure to private equity. In addition to the Pillar 3 and Pillar 4 we have been working on, we are also looking into the existing commingled fund. And also, as you know, that in public we discussed co-investment strategies. So later you will see in item 9C, part of the total fund policy revision is to enable us to tap into these different ways to increase our exposure to private equity. And also, I'm very pleased to share with you that our new head of private equity, Greg Ruiz, joined us a few weeks ago. So, where's Greg? So he has been leading the team very tirelessly from day one, even before he joined us. he has been working with the team very tirelessly, looking into all the possible ways in our existing fund model, commingled fund model, co-investment, as well as the new model we're proposing, the Pillar 3 and Pillar 4.
Thank you, Ms. Taylor.
Yes, thank you. Can I get you to look at page 22, staffing overview? I just was a little curious, and I appreciate the report. When we get down to the last total program, 50, is it 62 FTEs, full-time positions? 34, the last one, 34 support staff classifications, 6 SSMs, 9 AGPAs, 6 SSAs, 2 OTs, and 11 SCs. And for those folks who don't know what those are, we've got staff service managers, associate government program analysts, staff service analysts, office techs, and seasonal clerks?
Seasonal clerks,
Why
yes,
do we
that's
have
correct.
seasonal clerks?
That's basically a program that's in transition. These are folks that came and have worked in the organization. I think the organization is trying to eventually work down and remove the seasonal clerk exposure, basically, but those are folks that are basically contributing to the administrative work of the office still.
So you're working those, shouldn't those be office tech positions? Because I'm a little confused. Seasonal clerks are seasonal clerks, so we use them at the department I work in, so.
Yeah.
For the season.
Yeah, I think Dan can help with that discussion.
Sure, Dan Bienvenu. So we have used the seasonal clerks when we stopped doing an intern program. So years back, we used to have an intern program. We started using seasonal clerks for that, where they would be students, because we got rid of the student intern. This gave us sort of an extended interview period with these sort of student-level part-time positions. To be fair, the state has migrated towards not wanting us to do that, and so we're migrating away from that practice.
So both the student and the seasonal clerk?
Basically looking to go back to an intern-like program of some sort and stop the seasonal clerk program, because seasonal clerks in the state organization are really intended for things like lifeguards and things like that.
Well, we use them for tax season.
Or for tax, exactly,
yeah.
for various high seasons, but they're
Yeah.
seasonal by definition, and we have not used them seasonally, which is why
Right.
we're gonna reduce that usage.
Okay, so, and then I would assume, so you're saying they're going to be interns. What is our definition of interns, and are they paid?
We are working our way through it, but our definition of interns they have been paid historically, and my sense is that they will be paid going forward.
Are they a state classification?
I'm getting to a level of depth that I'm going to
Let me take that one. So this topic is very topical now in the investment office. Just as Friday, John Cole and a few student interns. We have 5 interns this summer in the office. Myself, John Cole, and few Scott Greenberg and Lauren Rosborough, together with the 5 student interns. So I hosted a lunch last Friday to talk about their experience and our desire to restart a formal internship program. If you look around the investment office, we have had quite some success from the internship program. We have a number of very good employees. They came out from our internship program. And if you recall my presentation to you in the July offsite, we talk about building the pipeline, the succession plan, the talent management. And for us, we are not in global financial center. For us, we really need to start early and start local. So once people get to know CalPERS, get to know our purpose, what we do, and how we treat people, the hope is that once they buy into our culture and mission, they are likely to stay locally, and hopefully they'll come back to work in our office for on a full-time basis. So again, we look around the past couple of years, we have had great success, and for some reasons, somehow we stopped the internship program. So as I said, as yesterday, Friday noon, we're having this discussion to restart the internship program. And ideally, they should be paid. Currently, it's unpaid, but we're looking into ways to pay them, to have a formal internship program. And we're working with HR very closely on this.
So, and I do not approve of unpaid internships. I just want to make that very clear. Are you working with any organization like Mayor Steinberg's organization for interns?
Hi, Doug Hoffner, CalPERS team member. Yes, to your point, so we have the 5 we were talking about, the high school students from the 5-county region around Sacramento are through the mayor's program. Those are paid internships. They're clearly going to go back into school now at this point, given
Sure.
We have had folks working through Sac State through the internship program as well. Again, while they're not in school, looking to, and they would be paid as well. So that's part of our program, is to bring people in early on, get that summer experience or longer if they can work part-time while they're here in the Sacramento area, and then hopefully have a longer-term experience with CalPERS once they do graduate. So
Now, how
it's
do we
kind of a layered approach.
get away from the summer programs since they're all working summer programs? Are we, like, because if 11 of them, which are currently seasonal clerks, you need 11 interns, but they can only work in the summer, so who picks up their load of work at that point?
Yeah, so I think the seasonal clerks, that's in addition. So we're talking about this student internship program. The seasonal clerks could work at different times throughout the year. The ones in the internship program are typically based in the summer when they're not in school, but they could work as well depending on their schedules and school classes.
So is that how you're paying them, is to call them seasonal clerks? Is that
No, I think we're talking about 2 different things. We have an internship program, and then we have seasonal clerks in the organization that are paid employees as well that work on a seasonal basis. I think to what I heard earlier was we're looking to move away from the seasonal clerks more to a traditional and build out that internship program. Right now we have approximately 5 in the high school level and maybe 7 in the sort of, Sac State college level at this point.
So you're using those in addition to the seasonal clerks currently in the investment office? Okay.
Yes.
Correct.
So then you'll have to move 11 more positions into those, no? I'm very confused. Okay. I'm just trying to figure this out so that we aren't avoiding using state workers, which is my concern here.
Mr. Miller.
Yeah, thanks. And again, kind of my return to my mantra, I'm really glad to see that we're thinking about that pipeline in terms of a strategic workforce planning in a longer term sense. And it's something we can certainly talk about a little bit more. But in my experience in regulatory agencies, we've had very good results working with university, like the Hornet Foundation, for example, to bring on year-round interns both at the undergrad and graduate level, and they were really quite fairly compensated, and it really became a useful pipeline to get people interested in public service and get them in the door. So I'd encourage you to continue to pursue those opportunities to cultivate and bring in more talent to public service.
Thank you. Ms. Oliveras.
Thank you, Mr. Chair. I'd like to take us back to page 12, please. And this has to go with the discussion that Ms. Brown mentioned regarding the benchmark one-year return for private equity being 4%, and that being tied to the opportunity cost relative to if those funds were invested into public equities. But I see that the one-year benchmark for public equity is actually 6.2%. So I'm not really sure how that works. And then the other point I wanted to mention, typically what I'm used to seeing, and maybe it's different on the pension side than insurance companies or investment funds, but when we're looking to benchmark performance of private equity, we're doing it based upon using services like PitchBook, those types of things, looking at top quartile returns based on the strategy. So I'm wondering if we've ever looked at doing some type of weighted return based upon the strategies?
So your first question, the benchmark for private equity, and that's a public equity benchmark, and your observation that why it's different from the public benchmark return for the same period. So as Eric mentioned that the private equity benchmark is lagged by 1 quarter. So that's the 4.0% return. It's like the 1 quarter public equity return plus 150. And then the public equity, the benchmark 6.2 return, that is the current quarter return, not lagged. So that's the difference.
How does that compare with other pensions and how they benchmark one-year performance for private equity?
So I will speak to that, and then we can call our consultant as well. So generally speaking, there are 2 ways to benchmark private equity. One is to benchmark to peer group, to a private equity universe. But the challenge is there that, as you may know well, there's not really a good comprehensive private equity index out there. So it suffers from a number of biases, such as survivorship bias, self-reporting biases, and sometimes we only see the benchmark return. We do not really see the details of an underlying strategy. So we cannot really compare apple to apple. So that is one way to benchmark private equities to your own private equity peers. And the other way to benchmark private equity, as what we do now, as Eric mentioned, is we benchmark against opportunities cost. So if you look at private equity, is by and large is to gain the same exposure as public equity, but with illiquidity. So we benchmark against our opportunity cost, which is public equity plus 150 bips to compensate for the illiquidity. So you will see if you talk to other pension funds and our global peers, you probably will see most of their practice fall into these two categories, either benchmark against private equity peer or a benchmark to a public equity plus a spread, plus a premium approach.
So this is then the public equity benchmark return less the liquidity or illiquidity.
Public benchmark return plus illiquidity, 150 bips. So you see 6.2, so that's a 1 year ending June, June 30th. The 4.0 is a 1 year ending March plus 150. And if you recall the first quarter or the second quarter and the last quarter last year, so you see the difference is mainly between one quarter, the second quarter of this year.
It's a different way of displaying it than I've seen before.
Yeah.
Thank you.
Mr. Hart?
Yes, Steve Hart from McKeith Investment Group, private equity consultant. As Ben was explaining, in the industry, there's essentially two methodologies used for the benchmarking. CalPERS is choosing to use the public equity benchmark plus a spread for all time periods. Other pension plans use a peer index to augment that to show, but there's issues with regards to using that peer index in that several issues with benchmarking generally, but getting that benchmark in terms of its portfolio composition to look similar to what the CalPERS benchmark portfolio is a real challenge, and all sorts of issues about whether it's investable and things. There's lots of issues in using peer benchmarks as well, and that can be information that can be provided, but there's just challenges in just doing private equity benchmarking just generally.
Thank you.
All right, thank you. No other requests? Mr. Beckerson?
Okay, let's see. Well, we've gone through an array of different topics so far this morning. Perhaps the only other element that I might just point to, or just very quickly, just touch on two slides. One, this is basically the ALM cycle. This is shown on page 15 of the attachment. The next activity where we'll be bringing information to you as a board will be pretty much just about a year from now when we do our mid-cycle review. And this will be a topic that the TLPM team is working on over the coming year. I think the only other place where I might just spend a moment would be just reiterating some of the work that was done in the last strategic asset allocation. One of the elements that came out in that work was to try to understand relative to the portfolio priorities, which were another adoption by this board, and I think we've got some information on that in the total fund program review and agenda item 9A. But one of the concerns that we had in that asset allocation work was the potential exposure to significant drawdown risk, and that drawdown risk typically emanates from the public equity portfolio. And that's obviously what we experienced in the financial crisis in 2008 and 9. When we did the asset allocation work, we looked through the lens of equity drawdown risk and tried to ask ourselves whether there are different interpretations of what could constitute the market that might mitigate some of that drawdown risk. And the investment committee made the decision to add some market segments both into the public equity asset class, where we have a market factor exposure that experiences an improved risk profile and equity drawdowns, and in the fixed income area, where we have discrete allocations to both long-dated or long-duration U.S. Treasury securities. We have a high-yield component, with high yield acting almost as an equity substitute, and also then the residual of fixed income, which is called the long spread bucket. But those allocations into these market segments were implemented over the course of the last year, and when we do the total fund review, we'll get a little bit into some of the performance of those segments. But we were encouraged that the segments performed in accordance with our anticipation on the pattern of performance that they would generate. So I think with that, maybe I would just stop at this point and see if there's any further questions, and we'll touch on this in the total fund review also.
Mr. Jones.
Thank you, Mr. Chair. Yeah, Eric, the public equity factor-weighted comments, I really would like for you to, not now, but when we get to that report, to expand on that, to show how that has enhanced our returns and also protected us for any potential drawdown.
Yes, we'll be covering that, Mr. Jones, in the total fund review.
Ms. Oliveris.
I'd like to understand better the liquidity range. It seems quite broad.
Yeah, the liquidity range basically, and this is where you see actually the ability to utilize leverage in the fund. So the liquidity target that came out of the last strategic asset allocation is 1%, the range being +3 to -6. So around that 1% target, what that implies is that we could basically have as much as 4% positive allocation to liquidity, or as much as a -5% allocation. That -5% equates to a topic that we discussed with the board a number of years ago called borrowed liquidity, where if we were experiencing real stress in the marketplace, that we could utilize some of the collateral and other capital that we have dedicated, but that would constitute an actual leveraging of the fund. So that's been authorized to be used on basically a short-term basis to deal with market disruption and things of that nature. But that's what that represents. This is where that would be accounted for.
Thank you.
Yeah, and later in item 9C, part of the total fund policy revision and update, part of the recommendations is related to the leverage policy. So the leverage used to be run at asset class level, and as many of you know, that as we are moving to a total fund approach, one team, one culture, we're centralizing all the leverage decision at the total fund level instead of each asset class level.
Thank you.
No other requests? Mr. Ragusin?
So now I would like to call on Kevin Winter, the Managing Investment Director of the Opportunities Strategies Program. Can you load the slide, please?
No, microphone.
Sorry about that. Good morning, Kevin Winter, Opportunistic Strategies. Opportunistic Strategies has mainly 3 areas of focus for this past year. First was managing the low liquidity enhanced return portfolio. Secondarily was executing most of those public market securities transactions for the various strategic asset allocation targets that we changed this year. And finally, working on leverage and liquidity at the total fund level. In the low liquidity enhanced return, this year we added roughly 6 basis points to the equity portfolio. We continue to work on finding additional securities that meet the goals of that program. Goals of that program being low probability of capital loss. We're giving some liquidity, but we know we'll get our capital back in the future. On the ESS group, this past year we executed roughly $150 billion in transactions to change the strategic allocations of the total fund. One of the big wins for the year was we had a separate target for strategic target for high yield. We thought the timing or the amount of time it would take to execute that strategy was going to take a lot longer than we actually did. We came up with a very interesting, innovative way to get that exposure, and it worked very, very well. Finally, we've done a lot of work this year on leverage and liquidity management. We've changed our funding mix. We brought the management up to the total fund level. Opportunistics worked very, very closely with TLPM to work on a framework for developing how we how much leverage we have, where we source our leverage from, and how that fits in with our liquidity profile of the fund. We will continue to do more work on this year and further streamline that program. With that, I'm open to questions.
Seeing none? Thank you.
Thank you.
Okay, so that takes care of the information items. Brings us to action item 8, independent oversight. Mr. Bienvenu.
Yes, sir, Mr. Director, thank you. As Ben mentioned earlier, item 8A is our lone action item for today's agenda. It is regarding the selection of the board's investment consultants, and we have 3 desired outcomes from this item. First is to approve the suggested interview process. Second is to request that the IC chair establish a subcommittee to conduct interviews, recommend the selection, and then come back to an open session of the investment committee to actually ratify that selection. And then finally, to determine the finalist firms that will be included in those interviews. By way of background, in March of this year, CalPERS issued an RFP to select up to 4 consultants, 1 in the area of general pension, and then 3 in each of the 3 for the private assets, 1 in each private asset class. It's worth noting that as part of the RFP, the firm that is awarded the general pension contract cannot be awarded any one of the private asset classes. So in front of you, you have the firms in each category that pass the technical criteria, which these could be your finalists, as well as the proposed process for selection, including direction to the chair to establish a subcommittee, to conduct interviews, to notice an open meeting where those interviews would occur, and the direction to come back to the IC with the recommended chosen firms. So staff's recommendation is to follow this process. We'll follow your lead in terms of selecting the finalists for interview. And from there, Mr. Fechner, I'll turn it back to you. Happy to take any questions.
Thank you. Seeing no questions, I do need to call on Mr. Jones and get authorization for the president to create a subcommittee. Mr. Jones. You went away. There you are.
Okay, thank you, Mr. Chair. You are authorized to establish a subcommittee.
Thank you. Appreciate that. I would recommend authorizing a 5-member subcommittee. It would be the chair and vice chair, Controller Yee, Ms. Middleton, and Mr. Perez. What's the pleasure of the committee? Moved by Taylor, seconded by Miller. Any discussion on the motion? Seeing none, all in favor say aye. Aye. Opposed, no. Motion carries. Anything else, Mr. Bienvenu?
No, sir. Thank you.
Thank you. Brings us to agenda item 9A, the CalPERS.
I'm sorry. We need to select the finalists.
Oh,
so
okay,
that's a great point. So I think we've got the process figured.
Very
we just
good.
need to finalize the finalists.
All right, you have the recommendation in front of you, board members. Ms. Ma?
Can I just ask, on the next page, there's proposed fees for 3 years? So is this tied to any type of performance, or we're going to pay this regardless of what the funds do?
The consultant fees are not performance-based. They are based on a flat fee, and they should be part of they are part of the scoring criteria, and they will be part of what's taken into account by the subcommittee making a recommendation on finalists on the selection.
So I'm just asking, I'm not on the committee, but the fees are a lot. And is that normal to have so many consultants at this level of fees?
The fees, agreed, the fees are high. Investment consulting costs are high. It's actually intentionally not part of performance because there's a potential conflict that's created there. So we've intentionally, from a governance standpoint, kept those as flat fees. But they are expensive services, but they do quite a bit of service for CalPERS. I mean, we're a big, complex organization, and there are only so many consultants that can actually take on our business.
Okay.
Ms. Yee?
Thank you, Mr. Chairman. I think to Treasurer Ma's question, I would just encourage my colleagues to remember these are our board consultants, and we should fully utilize them.
Very good.
What they're charging.
So the recommendation of the finalists is in your board packet. What's the pleasure of the committee? Moved by Brown, seconded by Miller. Any discussion on the motion? Seeing none, all in favor say aye. Opposed, no. Motion carries. Anything else, Mr. Bienvenu? We got it this time?
No, sir. Thank you.
Very good. Thank you. Moves to agenda item 9, information agenda. 9A is the CalPERS Trust Level Review. Mr. Meng.
Thank you. I'll turn it over to Eric Beckson again to cover the trust level program review.
Okay, good morning. Eric Baggeson again, Managing Investment Director for Trust Level Portfolio Management. And we also have John Rothfield down the end next to Mr. Bienvenu, and John will be providing an economic update after we get through some of the other items in relation to the total fund. So we have the executive summary. I think the main points in the executive summary are basically the performance for the fiscal year. The return for the fund in fiscal year ending 2019 was 6.7%. You see the 5 and the 10-year numbers. A 5-year return was 5.8%, and the 10-year number, 9.1%. And I would remind the committee that the 10-year number is basically almost exactly from the bottom of the financial crisis, which is one of the reasons for that level of return is coming up out of a significant hole. So that was kind of the rebound in the marketplace. One of the dimensions on performance also, it's the sort of second bullet point down in the summary, which is the excess return or the active return. And this is a topic that our Chief Investment Officer, Ben Meng, has been speaking about quite frequently. Our relative return was negative 42 basis points. So that is, again, we're utilizing active risk. We are basically taking variances from the structure of the strategic asset allocation. That could be the utilization of managers that are doing things such as picking stocks or bonds. It can also be weight variances from the target weights in the strategic asset allocation. Again, the discipline on this should be that we're only using active risk if we believe or have a reasonable belief that somehow that variation is going to result in a positive return. For the fiscal year, that did not happen. It resulted in a negative return. So one of Ben's significant projects that we're undertaking is really a review of the utilization of active risk in the plan with the intent to be very disciplined about the deployment of active risk only in areas where we have a great conviction that we're going to have a positive outcome. So there's a lot of activity that's happening within the investment office currently on this topic. And I'm sure you'll be hearing more about that in the future. Just on the risk bullet point, and we'll get into this a little bit more, but the risk in the plan is considered to be the volatility or the variability in returns that are generated away from the expected return. And again, our expected return on a long-run basis is approximately 7%, and that's also the discount rate for the fund. The variability around that return, though, a return, for example, this year was almost exactly on the 7%. That's a very unusual outcome. Typically, the returns will either be significantly higher than the expected return or significantly lower or even negative. So it's actually very unusual to have a return that almost sits exactly on top of the discount rate. But that variability in risk, that is generated predominantly by the amount of exposure that we have to equity-related assets. And that is a facet, again, that impacted the structure of the asset allocation work that was done, ending up with a decision in 2017. And we'll get some more into the segment work in a minute. But if we go on to performance on page 4 of the attachment, you see basically this is the Public Employees Retirement Fund, the PERF, which is obviously the fund that everyone thinks of when they think of CalPERS. But you also have listed out all of the affiliate funds. What you'll notice is that the return to the PERF shows the effect of that active risk. Typically, the majority of the affiliate funds are run with very, very little active risk. But you also see the variation that happens because of exposure to the private assets. So if you look, for example, on a 5-year or 3-year basis, you'll see, for example, the 3-year return for the PERF was 8.8%. That return is higher than any of the affiliates, the SERPT Strategy 1 being the next closest return to that. But that is basically the effect of actually having things like private equity and real estate in the portfolio. That those private assets can work to the organization's benefit or they can work to the organization's detriment, just depending on what's happening in the marketplace. I would also call your attention to the 1-year return column, the column on the far right, where you see, for example, the Public Employees Fund had a 6.7% return. That was exactly the same return as in the Judges System 2 fund. But what's very interesting is that the funds that have predominantly fixed income related investments, things such as the CalPERS Healthcare Bond Fund, actually had a higher rate of return than the PERF did for the fiscal year ending June of 2019. So the marketplace over our last fiscal year was quite unusual in the respect that fixed income instruments had higher rates of return than almost every other part of the portfolio, with the exception of some of the segment work that we did in public equities and to some extent private equity. So that's a fairly unusual outcome when you have, and that is not the way our asset allocation is established to really benefit in a time period where fixed income generates higher returns than equity exposure. The belief that equities will have higher rates of return than bonds is one of the fundamental belief sets that underlie the structure of our strategic asset allocation. So it was fairly unusual in that regard. The next page into the material shows the cumulative returns. And again, these are basically a 10-year period. And you see how the 10-year cumulative return, the very top line is the CalPERS benchmark. The line right below that is the actual outcome of the fund. And then the third line down, the grayish line, represents the discount rate. So what you're seeing over a 10-year period, both the benchmark and the fund have generated returns higher than the discount rate. And again, that comes from almost exactly the bottom of the financial crisis. So this is the springback in valuation of assets that have happened. But this represents the benchmark return cumulatively is about 146% over that 10-year period. For the fund, it was about 139%. And for the discount rate, it's about 107, 108%, somewhere in that ballpark. The next slide in the material gets into, again, some of the absolute returns. And the solid horizontal bars are the 10-year return numbers, and then the sort of hashed bars, or the shaded bars basically right below it, represent the one-year returns. So you can actually see the variance between 1 year and 10-year outcomes. If you look at the 1 year outcomes, for example, down, well, pretty much 2/3 of the way down the page, you get into the fixed income related areas, so total income, the long spread, long treasury, high yield. And you see all of those numbers for a 1 year basis range between about 8.5% up to 10.5% for the long treasury portfolio. Those numbers outperform pretty much everything in the equity space with the exception of the factor weighted equity portfolio. And the objective of the factor weighted part of the equity exposure is to try to mitigate against the drawdown risk. And we'll see a chart later on in this material that shows that it will trace how returns were generated over the course of the fiscal year. And what you'll see is that the areas where we incorporated these segments to try to minimize equity drawdown actually were successful in doing that to some degree or another and improve the overall outcome to the fund for the fiscal year. This chart shows, and this is on page 7 of the material, this chart shows the actual excess returns or the active returns. And that's exactly what we were just speaking about. So you see for fiscal year 2019, you see that bar dropping down below the zero. That's the negative 42 basis points. For the last few years, we have not had a good outcome to active risk taking. It has not been adding value to the degree that we believe that it should. But you also see, for example, that we haven't been experiencing anything like what we saw in the time period immediately after the financial crisis. That big bar in fiscal year 2010, so again, that would have represented the time period from June of 2009 through June of 2010. That represents a time period where we started getting walloped on the real estate portfolio and having significant drawdowns in the valuation of those assets. And there's been just a huge amount of work that has happened in the 10 years since then to restructure the entire way that we approach the real estate markets. That was started by Ted Iliopoulos and is carried on by Paul Machak and the real estate team to this day to try to avoid that kind of an outcome in the future. But this is a keen area of focus for our new chief investment officer, is to try to basically really apply more discipline in the utilization of active risk in the program. The next page shows 5-year and 1 year active return results. The areas where we've had the most consistent positive contributions from active risk-taking have been the areas attached to the fixed income portfolio. Again, you see this about 2/3 of the way down the page in both the solid bars and the hashed bars. You see exactly how, I don't know, how variable the outcome to private equity can be. That sits right about the middle of the page. So on a 10-year basis, we had a negative active return, but again, that was predicated and measured against a public equity benchmark plus a 300 basis point margin. So this shows it underperforming by 80 basis points, but that in essence represents a return that was still more than 200 basis points ahead of what we generated in the public equity marketplace over the same time period. So even though it was a negative relative return against the expectation, it was still a positive return that is not easy for us to gain from any other exposures that we have available to us. And then you see for the 1-year number, though, the private equity portfolio outperforming by almost 370 basis points. So that's a significant outperformance. One of the areas that we're working on pretty hard at the moment is in the area of the public equity portfolio. You see these small negative contributions, they're very small in the span of active return outcomes, but nonetheless they tend to be negative, and public equities represent a significant amount of this portfolio, being almost 50% of the allocation. So that's an area that we're concerned about. But one dimension of these pieces of information that you have to recognize is that our benchmarks do not represent any cost of actually maintaining that exposure. So the benchmarks are a purely theoretical construct that do not infer or impute any trading costs or turnover costs, which actually has to be incurred basically as our benchmarks get reconstituted periodically. So there's a degree of turnover in just maintaining even an index portfolio, and that turnover costs money. So the tendency of this asset class, even if you were taking absolutely no active risk, is to have some degree of underperformance attached to it, simply in the cost of maintaining the portfolio. And that's one of the realities that, again, Ben has mentioned in some of his discussions on trying to actually make these benchmarks represent the real opportunity set, inclusive of some of the cost that is required to maintain it. We get into, again, this is a repeat of some of the slide material that we had some questions about earlier in the trust level portfolio management program, but on a 5-year basis, our predominant positive contributions, and this again is excess or active return. This is not just the absolute outcomes that are happening to the fund, but it really just shows, again, the positive areas on a 5-year basis have come predominantly from the fixed income related parts of the portfolio. The private assets, part of that, again, is just an underweight to some of the asset classes, and also basically just adverse selection in the relative outcomes that have happened in some of those private assets. Just on the topic of risk, you see 2 pie charts on this page. So one pie chart actually represents, the one on the left-hand side of the chart, represents the actual asset allocation. So you can see, for example, we have on the right-hand side of that pie, we have public equity cap weighted 35.5%. We've got the factor weighted 14.6%. But basically that makes up half the portfolio, equity-related assets, and that's not even yet including the assets that are invested in private equity, which also have similar kinds of risk exposures. So we have in aggregate, pushing towards close to 60% of the portfolio invested in equity-related asset areas. If you look at the pie chart, though, on the right-hand side, that's the risk contribution proportion. So what you see is that the equity exposures, all the public equity exposures, add up to almost 3/4 of the actual risk outcome. So the risk impact of the equity investing is significantly higher than the actual asset allocation attached to that. And that's just been a facet that has been driving the outcome to this fund for decades, as long as we've had significant equity investing, which really started taking place in kind of about the, sort of the 1970 into 1980 time period, where we had significant amounts of equity investing. The line chart on the bottom of the page just traces the outcome to the public equity portfolio versus the outcome to the total fund. And you can see how closely those lines fall relative to each other. So what happens in the equity markets tends to drive what happens to the fund, and that's going to be the case as long as we have the proportion of equity investing that we do have. And this is not atypical for virtually every public pension fund in the United States, and honestly, many of them around the world as well. All of these portfolios have tended to migrate to a space where there's a lot of equity concentration as we attempt to keep the expected returns up into an area sufficient to provide enough return to be able to afford the pension benefits that have been promised. This gets into some of the material that both our Chief Investment Officer has referenced. Ben has used this drawdown chart in some of his other presentations with you as a board, and also the questions that Mr. Jones had about the rationale as to what was some of the considerations that were driving the selection and the utilization of market segments in the strategic asset allocation work as it was last done. And what you see in this chart is just the magnitude of periodic drawdowns that happen in the equity markets. And this traces all the way back into the Depression and the financial crisis that happened starting in the late 1920s and continued on through most of the 1930s, and honestly didn't ever come back to even until we got into almost the year that I was born, in the 1950s. So it took literally a 20-year plus time period to get back to the place that it had started from before that happened. More recently, you see the two big drawdowns that we had in the 2000s, the dot-com crisis, in the sort of 2002 time period, 2003 time period, and then the financial crisis that happened. And obviously, the financial crisis is one of the worst drawdowns, or I think it is the worst drawdown that happened since the Depression. So that was a pretty significant event. And the sensitivity to what these drawdowns can do to both the funded ratio of the fund and the impact on contributions to the employers is the reason that when we went through the last strategic asset allocation work, we focused through the lens of trying to mitigate some of that equity drawdown potential. Now, it is not possible to eliminate all the exposure to equity drawdown when you have an equity-centric portfolio. But nonetheless, we tried to look through that lens of equity drawdown and say, are there other ways that we could define the marketplace that would mitigate or minimize to some extent the potential effect of those kinds of equity drawdowns? And that's what led us to this concept of asset segments. And this is a body of work that we spent a significant amount of time over the year of 2017 communicating with the board, both in agenda items, workshops, and a number of other venues, going through the public asset classes, saying, are there other types of benchmarks or structures that could serve to reinforce this concept of drawdown protection or greater diversification, because basically those are almost the same terminology. Where we ended up with, and the decision you as a board made in the asset allocation, was to break the fixed income portfolio into three segments. Again, it's a long treasury segment. Treasuries tend to be a protective asset when you have severe market dislocation or stress or financial crisis or whatever you care about, because there typically is a flight to quality. So treasuries tend to be an asset that not only hold their value, but oftentimes actually appreciate in value if you're having a severe problem in the financial marketplace. We also had added a high yield segment. And high yield is very similar to the kinds of returns that we expect from equity investing, but it actually is based on a promise or a fixed income instrument. So we felt that having a specific segment and a specific exposure to high yield acts as a bit of a substitute to some of the equity risk in the portfolio, which serves to maintain some of the expected rate of return, but also has a slightly different drawdown profile. High yield does tend to get hit if there's a big sell-off in the equity market, but it does not get hit to the same degree, for example, as typically like a market cap-weighted equity benchmark. And then everything else in the fixed income portfolio is lumped into the category of what's being called long spread. So that's corporate bonds, it's mortgages, and a number of other types of instruments, basically, that did not display characteristics significant enough to warrant their being called out as a separate segment. Then in the public equity space, I don't know if you recall some of those diversification charts, the SMILE charts, where we have lines that bend up and lines that bend down and all that kind of stuff. But what we determined was that using a market factor type of an index, where it is exposed to a different, well, let me back up. Our basic benchmark for public equities is a market capitalization global benchmark. So we use the FTSE All-World All-Capitalization benchmark. Market capitalization is just simply the number of shares outstanding times the price of the shares, and that creates a market value for a company, and that market value, with a few adjustments, then determines its proportional weight in the overall benchmark. So market cap benchmarks tend to represent the financial marketplace or the equity markets in aggregate as to the returns that will be generated. There are a number of market factors which are viewed as dimensions or parameters that categorize securities in a way different than market capitalization. So these factors, there's a whole array and a whole gamut of them. We looked at an array of different factors, and we decided on adding another market segment to the public equity exposure that was designed to be as different in its performance characteristics. And when I say different, I mean different relative to the market capitalization weighted benchmark. So we're trying to maximize the degree of difference, even though these things are both equity exposure. So they tend to have very common patterns of performance, but the magnitude can be somewhat different. When we assembled these market segments and we went through the asset allocation, we incorporated an allocation, the target allocation to the equity factor-weighted segment is 15% of the total fund, which represents a pretty significant allocation. We have, I believe, a 10% allocation to the long treasury exposure, and we have a 3% allocation to high yield, and then, all of the other asset allocation exposures derive from those numbers. When we actually look at the outcome that happened, and remember, the year of 2018-19 was the year of transition. So we were basically acquiring these exposures. We were moving money out of the market capitalization weighted part of public equities and into the market factor weighted part of public equities. And again, that represented 15% of the fund. So there was a lot of turnover activity that happened over the course of the year. What you see on this chart, page 14 of the attachment, is the variation in the outcome that happened. So the lower line on this chart is the line that represents the outcome that would have happened had there been no changes to the asset allocation. So if we had just kept the asset allocation structure that we had at the end of 2017 and carried that all the way through the last fiscal year, this is the red line on this chart, or the lower line is the outcome that would have happened. And that represents a return of approximately 6%. The top line is the outcome that did happen, and that had a return of 6.7%. That means that the implementation of the asset allocation, even though it took the entire year to complete that work, did have a positive effect on the fund that added approximately $2.5 billion to the overall market value of the fund, or 70 basis points. And that's a pretty significant achievement. But what's even, that's an outcome that was fortuitous. But these things are different. These market segments are different than the places that we came from in the asset allocation. So there is an environment where those market segments could actually underperform as well. But what we were actually most gratified by was the pattern of returns, because you see that, for example, the big differences, the biggest gaps, were when the market was in selling off. So we had the market selling off into the end of December 2018, and you see that there was a significant gap that opened up between the two lines at that point. Then the market rallied going into April of 2019, and that gap slightly closed. So again, but it still maintained a positive increment. And then we had another severe sell-off, or significant sell-off, going into May of 2019, and again the gap opened up, basically. That gap opening up is reflective of the fact that these assets are not selling off as badly into a drawdown situation as the asset allocation that we started with. So these market segments performed pretty much exactly in alignment with what we thought would happen, basically, going into this exercise. So even though this is just a one-year period, which doesn't really mean much of anything, we're nonetheless gratified by the fact that at least the characteristics that we thought would come through this segment work actually evidenced itself in a year that had significant volatility attached to it. And I think that basically completes the comments that I would have, and I just ask if you have any questions before we turn it over to John for his economic update.
We do. Mr. Jones.
Yeah, thank you, Mr. Chair. Thank you, Eric, for expanding on this segment, because I think it's very important that we get a clear understanding of the outcome of that strategy. And I'm looking at this chart of 14 of 17 here, but I'm also comparing it to, and not comparing it, but also using it to look at chart 11 of 17. And I was just, see if I'm interpreting this correctly, looking at the portfolio allocation compared to the contribution to volatility, and looking at the public equity, it's weighted at 35.5% on the allocation, and it jumps to 53.9% on the risk volatility. But then I see you carved out the risk factor, the factor weighted public equity, and that was like 14.6% of the allocation. But it only added to the risk up to 16.9. Yeah. So am I saying that if you had not carved out that piece, then we would have had a bigger drawdown because it's not as risky?
That's exactly right, Mr. Jones. I mean, you're basically putting your finger on exactly the element. What we're hoping that the market factor segment does is while participating in the market doing well, we want it to basically act as a buffer on the drawdown. And the fact that it does do that basically results in its lower or relatively lower risk contribution compared to, for example, the capitalization weighted equity portfolio. So you're exactly right.
Okay, thank you.
Just in reference to that, let me just back up for 1 second to our performance chart. If you look, this is the absolute returns, 10-year and 1 year, but really it's the 1 year number. The factor-weighted segment in public equities over the fiscal year actually had a return of 13.4%. That was over 800 basis points in excess of what the market capitalization return was. So this thing had a significantly positive outcome in the valuation of the fund. Now that actually, though, is a fairly unusual. I mean, that 800 basis points, this portfolio operates and it has tracking error or tracking variance relative to capitalization weighting of somewhere around 400 basis points, somewhere in that ballpark, Dan. So an 800 basis point outperformance would actually constitute almost a 2 standard deviation outcome. So this outcome is even better than what you would actually expect in a normal set of circumstances. So again, we're not keying off the return difference so much, but we definitely are encouraged by the pattern of returns that were generated, and it just happened to generate a very good outcome in the last fiscal year.
If I may, just one comment to that. So as Eric said, the factor-weighted segment of public equity has performed exactly as we anticipated. So when there is market volatility, it should outperform the cap-weighted benchmark. So on the flip side, when markets come and start rallying from here, we probably expect some underperformance of this segment. So just as a word of caution, it does not perform this well in all market environment. But in the down market, we needed it to perform better than other asset class, and which it has done. But when the market rallies, most likely this segment will underperform.
Ms. Ma?
Yeah, if we can go back to page 4, performance summary. So do we manage all of these other funds beside?
Yes, we do.
And
Yes.
Are there target or benchmarks that they're supposed to hit as well?
Yes, exactly. This board has approved basically the asset allocation for all of these affiliate funds, Ms. Ma. That's a piece of work that happens subsequent to the decision on the asset allocation for the PERF, basically. So that happened over the time period. I'm trying to think, when was the last decision? April, May, and June, basically. So that typically follows on right behind the strategic asset allocation for the PERF.
So if we're managing the funds, are all of these folks in these different funds also getting reports from us on a, I mean, like, we only usually just talk about our own fund, right? So.
Ms. Ma, your questions are music to my ears, because we've been talking about how the affiliates, we owe the same fiduciary duty to those funds as we do the PERF, and we tend to focus on the PERF because it's a $370 billion pot, but this is still $20 billion, which is a large asset management function for many organizations. So yes, we run them through the same allocation process, and as Eric said, in April, May, and June, Christine Reese and Allison Lee were here working the board through the various allocations to each of the trusts. We do, in the case of the defined contribution, we not only, we have an administrator do it on our behalf, but we not only provide reports to the employers, but we actually provide reports to the defined contribution participants. But so yes, we do very similar reporting, and as I say, the same fiduciary standard.
And so is there like a three-part, right? We have to hit a certain target, the 7%. There's a contribution by the participants as well as local governments. How are these funds set up?
Yes, each of them are different. So the judges is actually a closed fund, the first one. The Judges 2 is a separate fund for the judges, and yes, it has a set of contributions by both the judges themselves and then also the employers. Same with the legislators. In the case of the 3 SERP strategies, those are pre-funded healthcare largely. Those SERP strategies are pre-funded healthcare, similar to SEPT, which is pre-funded, the one that we just recently launched, which was the pre-funded pension contributions. Then you've got the healthcare bond fund. That is just basically a reserve fund for healthcare needs, basically costs that have not yet been incurred, but that is there as a reserve to pay those. You've got the long-term care fund, and then the terminated agency pool, which is actually technically part of the PERF, but it's for employers that have terminated their plan.
Ms. Ma, just as Dan just gave you some flavor, as Dan said that each one of the programs is different. They're different in their mandate and objectives. They have very distinct difference. And so as you can see, their portfolio setup, the return and the risk characteristics are distinctly different as well. So that shows the complexity of our investment portfolio and the investment office. Very few of our peers run such a complex program. So we manage not just the PERF, we manage a number of other affiliated programs. And as Dan said that, we have the same level of fiduciary duty to each one of them. That goes to say, when we talk about the budgeting of the investment office, the size of the investment office, it is worthwhile keeping that in mind when we benchmark ourselves against our peers. Very few of our peers manage such a complex portfolio.
Okay, well, that's good to know. Like, when we were talking about the consulting contracts before, and I said they were high, to be able to justify why they're so high compared to perhaps other pension funds across the nation, or, it's just good to get that explanation on record that we're doing more than normal pension funds, and therefore it requires a level of sophistication or, reporting. That's good for us to know, because as we're here thinking it's just, for me, I just thought it was just the one fund, but now that we're managing all these other funds and have a fiduciary responsibility as well to these other funds, it kind of changes, I think, the way I think about these other funds, number one, and number two, the amount of work and complexity, right?
Absolutely.
That it takes to
and this is only to the investment office. And if you look at the enterprise led by Marcy, we also run the second largest health program in the nation after the federal government. So that is another level of complexity tend to be underestimated when we compare to our peers.
Okay. Thank you.
Mr. Jones.
Yeah, thank you, Mr. Chair. Yeah, following up on Mrs. Ma's question about notifying the agencies and the participants in these various funds, Which of these, if any, are we required to report to the legislature on an annual basis?
You know, honestly, I'm not sure what is required to be reported to the legislature, Mr. Jones, but we basically report in our consent reporting that happens every month. There is information on all of these affiliate funds attached to that body of information, but I think we'd have to check.
Yeah, I remember seeing a report come through one of these committees to the legislature and trying to understand which ones.
Mr. Jones, Brad Pacheco, CalPERS team. All of the funds that the gentlemen have been talking about are mentioned on our annual financial report, and that's submitted to the legislature once a year. So essentially, the legislature gets information on all of these funds.
Okay. But I thought I saw an individual report to the legislature, not part of this CalPERS.
We can double check. There may be.
I see Mike was.
Oh, there you go.
Michael Cohen with CalPERS. There are, in particular, the actuarial reports that we do in the spring go to the legislature, and those have cover letters I remember seeing, and that sort of give a little bit of context regarding the particular funds. So there's the actuarial reports, and kind of the these regular updates that the investment committee gets. The legislature certainly has access to information on all of these reports, but the actuarial reports may be what you're thinking of.
Okay, thank you.
All right, so you know the request, Mr. Magnuson?
Thank you very much. Let's turn it over to John Rothfield, and he'll give us an economic update.
Thank you, Eric. My slides are pages 16 and 17. And I wanted to, page 16 is kind of backward looking and tries to explain why, as Eric mentioned, we had more of an index-like year for the return of assets, despite what seemed to be a fairly turbulent year in terms of policy and economic trends. And the forward-looking piece is on page 17. So getting back to page 16, if you look at the middle chart on the top, the main measure of US economic growth is gross domestic product. That grew by 2.3%. And by the way, June represented a 10-year economic cycle, which is a record for the US. We just reached a record economic expansion. And 2.3% turns out to be the average of that entire expansion. So again, while it seemed like a fairly volatile year for the economy and for policy, we landed at about a 2.3% economic growth rate. Looking a little bit into the composition of some of that, which is the blue bar, consumer spending actually had a good fiscal year. We had a very poor winter for consumer spending, but then a very strong recovery into the spring and the summer. And it's quite good quality of consumer spending because it happened not with consumers borrowing or running down their savings, but the savings rate in the economy actually increased to 8%. And consumers were not taking out much debt except in specific areas like credit cards and auto loans, but in things like home equity loans and mortgages, the new debt creation was relatively benign, unlike the early 2000s and what turned out to be the subprime crisis. That strong income growth that led to strong consumer came from employment growth of 188,000 workers per year in our fiscal year, and as a result of that, the unemployment rate fell from 4% to 3.7%, which is a nice low number for the unemployment rate. The areas of the economy that didn't do too well are business capex and housing. A few reasons why business capex didn't do well. Energy prices came down, so some of the mining investment in some of the fracking states came down. The problems with the Boeing aircraft led to reduced capex by the aircraft sector. And also, of course, because of the slowdown in the global economy and the strong dollar, we had an earnings slowdown in the US. So earnings growth essentially this year has been quite flat on a year-on-year basis, and one typically doesn't see much business capex in a weak earnings environment. Housing was also another sector which has been quite weak. Some people worry about that because housing is often a leading indicator of the next stage of the economic cycle. But Essentially, this has been a slow cycle for housing, really based upon the fact that there has been a preference for multi-dwellings and rentals, and real estate commissions have been relatively low because there hasn't been much churn in the housing market. So if you look at things like consumer plans to buy a house and the Home Builders Association expectations for traffic coming through housing, housing has slowed down, but it's not probably something that's going to trigger a more serious problem in the economy. And then finally, government spending has actually been strong. State and local governments have improved their finances to the degree that you've seen those jurisdictions increase their construction spending and also their employment. And then if you look on the right-hand side of that chart, foreign trade has been very weak. That's partly because as our global trading partners have had weak economies, they're not buying many of our exports. Also, there was a rush of imports into the US as a result of trying to front-run some of the tariffs. So there's been a lot of volatility in that part of growth that's been caused by the trade wars. If you look at the right of that, you can see what we call the Atlanta Fed labour market spider, which suggests that a lot of labour market indicators are pushing toward the edge of tightness that they've experienced over the last 3 or 4 business cycles. But there are still areas where there's possibility of finding increased labour supply to keep the expansion going. The 2 charts on the bottom indicate that one of the problems in the global economy right now is basically exports have dropped off, purchasing manager indices have dropped off for activity, particularly in the industrial sector as opposed to the service sector, and leading indicators are suggesting that the global economy downturn is getting worse. But overall, you know, one of the main drivers of the market has been this, the US economy with the US consumer sector and the strong growth of employment over the past year. Things like jobless claims have been relatively low, and we haven't seen that shoe drop at the extent in the economy. When you look through on the next page to the future, a couple of the messages is, you know, one of the other factors that has tended to hold up risk markets has been that central banks have turned from a tightening stance to an easing stance. So the Fed quickly began to tell the market that it would stop raising rates, and then on July 31 actually delivered a rate cut. The European Central Bank similarly, and in fact in a speech in Portugal in June, the European Central Bank started to talk about doing whatever it takes to get the European economy going again. So these central bank pivots have been another reason for the strength of asset markets in the last fiscal year. The message on the future when you look at macro is that it's probably more difficult to continue to deliver these kind of returns, partly because central bank supportive action is already priced into the markets to some degree when you look at what's happened to much lower bond yields. Also, while optimists say that a China trade deal would unlock pent-up activity in the US economy, an incremental trade truce that, for example, takes us through to the next election doesn't get over the fact that there's a lot of adjustment required by the US corporate sector, which has 40% of its sales in foreign jurisdictions. They have to continue to adapt to the new reality of ongoing trade disputes and tariffs, and that is probably a longer-term constraint on their CapEx. So, you know, while US economic growth and risk market returns are not highly correlated, this doesn't seem to be a promising environment for aggregate returns in the period ahead. One thing to remember is that the Fed has started to cut interest rates. There have been past episodes where a Fed rate cutting cycle, like by Chairman Greenspan twice in the 1990s, Chair Yellen's pause on rates in 2016 were actually enough to prevent a recession happening and were actually good for risk assets. But right now the bond market is telling you that it could well be too late for this easing cycle by the Fed because of what's happening globally and its impact back on the US corporate sector. So the market is saying to be cautious in terms of adopting a risk posture in the markets. Thank you.
Thank you. Ms. Middleton.
Okay. Yes, I think the big question that all of us are looking at in the general media is, when is the next recession going to strike us? So could you describe the activities that you've taken to stress test what will happen when there is a downturn in the economy? How many variables have you put into that in terms of the extent of that downturn? And most particularly, what will be the cash flow impacts for CalPERS depending on the nature of the next downturn?
Okay, that's a very good question, and it has been the focus of the investment office in the past 6 to 7 months. So let's start going back a little bit. In the recent past, in the past 2 years or so, the organization, again led by the board and the management team working together with stakeholders, we had took some really major steps to prepare the fund, better prepare for the next drawdown. So I will go back first with the additional cash contribution from the state, which is close to $10 billion now. So every penny of cash comes to the system directly goes to the bottom line. So that really helps the fund's ability to sustain the next downturn. And other decisions such as lowering discount rates and shortening the amortization schedule. If you think of our pension buck, about 60 cents of a dollar coming from the investment office, and the other 40 cents coming from contributions. So so by lowering the discount rate and shortening the amortization schedule helps on the investment side, the 60 cents or the 59 cents of the pension buck to sustain the downturn. But of course, we'll try everything we can to minimize the pressure on agencies, on the employers. So that helps. And then the other thing, as you can, Eric just mentioned, if you go back to slide 6, as Eric just discussed the risk segment work, as you can see that for the factor-weighted risk segment plus the fixed income somewhere down in the second half, the long spread, long treasury, and high yield, they all outperformed during the recent volatile market environment. So that helped us. Portfolio is much better positioned to survive the next drawdown. So these are more longer-term strategic decisions. And then the other point is that I want to say either June or May, I led a discussion talking about the next drawdown and what we are doing in terms of planning preparing ourselves by developing a plan, and so that when the crisis comes, we can keep calm and carry on. The reason we can keep calm and carry on because we have predetermined plan, well thought out plan. So on that note, I'll go back to liquidity management. We talked a number of times, and to the last part of your question about our cash flow position. So our overall objective is to survive the downturn and then thrive from it. And we're much better positioned than when we were in 2008. And on the liquidity dashboard, we're developing a liquidity dashboard I shared with the management team. The first draft is a workable solution now. And the team has had 3 wall gaming exercise to stress test, to your point, to stress test our liquidity profile during the next downturn. And then last Thursday evening, the senior team of the investment office, 35 to 40 of us, we had a long discussion to go over the plan again. So that was as recent as last Thursday evening. So in terms of all the scenarios, if you go to slide, slide 12, so those are the, how do we stress test ourselves? Slide 12, please. So these are the historical scenarios. We stress test our liquidity profile. Can our fund survive if any of these historical scenarios were to happen today, given our portfolio today? Were we able to survive? So each one of these, we stress test our portfolio. In addition to these historical scenarios, we also stress test some hypothetical scenarios in the future that may happen that we haven't seen in the past yet. So we also have a number of hypothetical scenarios to test our portfolio and to see, do we have enough cash flow to survive first? And then in addition, as Eric mentioned, borrow the liquidity. And when we need, can we borrow liquidity, borrow money to to deploy in the capital market to take advantage of market dislocation during the downturn. So we are confident to say that we are in a much better position than we were in 2008. There's still some additional to work, but given the action, the partnership between you and us and the stakeholders, all the steps you have taken, the management team and the investment office have taken, we feel much more comfortable where we are in terms of preparing ourselves for the next downturn.
Okay. Thank you.
Ms. Taylor.
Thank you, Mr. Chair. So thank you very much for your report, John. I always enjoy your economic reports. So I just wanted to, I just kind of wanted to go over a couple, I think you mentioned three things that were showing some weakness. The housing slowed down, energy slowed down, there's a labor tightness. Oh no, 4 things. Exports are looking kind of weak. So our trade issue, you said, it says something different here, but you said that the trade issue actually could be a long-term thing even past our current administration. Is that what you were saying?
I think so. I think the point probably is that we could get a truce on tariffs, which could extend the tariff hold off until after the next election. But businesses have to plan with their CapEx and their supply chains for the long term. And there's really no guarantee that we're going to get into a situation where corporates can be comfortable about a certain environment going forward. Now, whether that outlasts this administration, I'm not sure, but I think a temporary truce on tariffs is not enough to regain that certainty that the corporate sector is worried about in terms of both CapEx and supply chains.
Got it. Okay. And whether or not it survives the Trump administration or not. The reason I asked is because I read an article that Japan and South Korea now are having a trade issue, and I'm wondering if this is just our administration starting these trade issues are beginning to spill over into the rest of the world, which could also be a problem with our markets. But I was wondering if that was part of this as well.
Yes, I think so. I think the probability of a no-deal Brexit, which would disrupt supply chains within Europe, is another factor. And as you mentioned, the South Korea-Japan issue goes back to prior World War II. But the fact that it's come up again right now may be related to the mercantilist trend in the world economy, and that does lead to some significant issues with supply chains because of where the important place that South Korea and Japan both play in those supply chains.
There's some commentary that I don't need to make, but it just seems like that we started something that is a Pandora's box, because everybody has long history of trade issues with each country that they deal with. The housing slowdown, which was an indicator of the previous recession, you didn't mention any, I mean, you said it didn't seem like it was going to be the same thing as the previous recession, but is it predicated on cost versus consumer ability to buy? What is it predicated on?
Yeah, so if you look at the prior housing bubble followed by the downturn, that was based on increased leverage, so the home ownership rate went up, renters became owners, and you also had a large home equity loan withdrawal happening. That's just not happened this time around, and we've just had a slow recovery in the housing market. Part of it, as you mentioned, is probably tighter lending standards. And we do, despite the fact that the lower income cohorts have managed to engage in some catch-up recently in terms of income growth, we have had widening income dispersion, which has led to both a supply and demand constraint on taking out mortgages to actually buy homes, which has the greatest GDP impact. So I think there's a combination of supply and demand factors there that have been involved. It has become more expensive to get the land and to build a house because of lumber prices. The fact that we don't have enough construction workers right now If you look at job vacancies, they're very high in the construction sector. So it's been a slow grind in that sector as opposed to something that's gone out of control and then started to come back. If you look at measures like housing affordability, they're about long-term average right now. We're not at a point right now where house prices, except in certain markets like the West Coast, California and Northern and Southern California, we're not in a point now where affordability issues are starting to impact the national housing market. And in fact, consumers have said they're quite open to buying a house right now.
Okay. Okay. And then you didn't, so of course we all heard about this last week. You didn't mention the inverted yield curve.
Inverted yield curve. There's definitely a cottage industry in recession risk indicators based on inversion of the yield curve. So temporarily the 2-year rate fell below the 10-year rate. One interpretation of that is it's foreign policy. The very weak and vulnerable Japanese and European economies, which are causing foreign capital to flow into long duration US bonds and is forcing down US long-term rates. And another story says that you have to have a significant and sustained inversion of the 2 to 10-year yield curve in order to be a very good indicator of future recession. So some of these recession indicators, which I think are also being developed in conjunction with this liquidity effort that's going on in the fund, are showing that there is something like a third chance of a recession within the next 12 months, a 33% chance roughly. The yield curve inversion is part of that, but there are some other indicators as well that are starting to turn over, like capital spending in the economy and just the tightness of the labor market.
So on the topic of inverted yield curve, I know I catch a lot of attention from the media recently, but it's hard to say that it is correlation or causality. So in the past, as John said, that when the curve inverted, particularly the 2-year and 10-year inverted, the probability of a recession in the next 12 months or 18 months is higher than when a curve inverted already when if you use a 3 months T-bill as the front end of the curve. So we don't really know it's a correlation or causality, for one. And for two, the only theory, one of the theories, the only plausible theory to me is that when the curve inverted, it may hamper a recession down the road. Is that if you think of commercial banks, their business model is really to borrow money from us as retail, our depository money, and then they lend out. So they borrow from us, they pay us on the front end of the curve. When they lend out on the long end of the curve. So if the curve inverted, it means that they cannot earn enough to their cost of capital. Right. So that will hinder the economic growth. If you think about commercial banks, they are the intermediary in the capitalism. So they facilitate the flow of capital and the creation of credit. But if they the more they do facilitate the capital flow or the more credit creation they do, the more money they will lose. So naturally they wouldn't do it. So that's only one of the plausible reasons I see for the causality between the inverted yield curve and the recession down the road. So, but still there's a lot of debate. Is a correlation or causality?
Right, right. Okay, I appreciate it. Thank you very much.
Mr. Miller.
Wow, so much to think about. A couple things that kind of strike me is, we see a lot more participation in this tightening in the labor market, but we're not really seeing big improvements or even modest improvements in wage growth and in income equality that seems to be driving things, even in terms of global risk in the economy and along with other big things like climate change and stuff. And it just seems to me, it's been a long, long time since I was in business school, but the model back then seemed to be kind of, a recession modeling is kind of a V. You get the curve and it's somewhat symmetrical and it comes back and then moves on. Then it kind of seemed to be, well, we still got this convex drop, but maybe it's more like a U. And then we see more recently, it's like, well, we still get the big convexity, but then it's like U, but then it's not symmetrical and it's taking a long, long time to recover. And so how do we look at things going forward? thinking that that might be more the, you know, the kind of picture we're going to see, particularly with, there's not much room for monetary policy to maneuver now unless going into negative interest rates or some craziness. And as a long-term investor, we certainly can weather even those longer recovery cycles where we've got this confluence of long-term business cycles, medium, shorter term, all kind of this amplitude effect that causes that big drop, but the slow recovery. So do you see it kind of, is the world and the thinking about recessions and recoveries changing in that way? And how do we address it if we're going to be thinking about how we use leverage and how we time our actions into that kind of recovery, regardless of the politics of who's president? It seems like more it's a when, not if kind of situation.
Yeah. So you had a number of questions. I'll take a stab and then turn over to John. So in terms of we're talking about the monetary policy, the effectiveness of it going forward, you're absolutely right that if you look at recent recessions on average, the Fed had to cut 5% to stimulate the economy to get out of the recession. Currently, the rate is about 2%. So we don't have 5% to cut, for one. And for two, if the Fed started in a way underwriting the trade policy, so if the Fed used the limited bullet to underwrite the administration's trade policy, when the economy really needs help from the Fed, we may not have even the 2% left to stimulate the economy. And the other one, your observation is that going forward for the future, if our established framework, analytical framework, still work or not. So yes and no. You're absolutely right, we are in a different environment in many sense. For example, in terms of monetary policy, how effective monetary policy is going to be, we haven't seen that before. And also the quantitative easing, we have not done that such a scale before either, how to unwind it. And other things, the economy today, global economy today is different from the past. It's much more globalized. And if you look at U.S. is very much a consumer-based economy. As John just mentioned, that's more than 2/3 of our economy driven by consumer. So even though we are experiencing a manufacturing industry or industrial recession, but the consumers are strong, buoyed by the low unemployment rate. And actually, the income growth, the recent one, more than 4% wage growth. So we see some wage growth as well. But back to your question, we use one of the framework we use. You hear in the media talk about the Philip curve, the relationship between unemployment rate and inflation. And then a lot of debate is a Philip curve still working or not. But if you look at it, again, the different economy we are in now, the San Francisco Fed recently published a paper. The Philip curve in the service sector, actually while and alive, works pretty well. But in the manufacturing sector, because it's more globalized manufacturing sector, so you don't see the effect in Philip curve. So just one of the example that we have to use established analytical framework in today's context. So that's create a lot of difficulty and challenges for all of us to manage a portfolio when the next downturn comes. So that's my 2 cents. I turn over to John.
Yeah, I agree with Ben there. If you look at the service sector, there are actually some signs that we're getting into a typical late cycle in terms of wage growth. So if you stay in your job, the aggregate numbers are showing you earning 4.2% on average more than a year ago. If you change jobs, it's more like 4.5% right now. The reason the aggregate wage bill in the economy is growing only in the 3s is that the new workers being brought into the labour force right now don't have the kind of skill set as everybody else who'd been drawn in earlier in the cycle. So the new entrants tend to be paid lower, so the average stays down. And then the national accounts were actually recently revised to show that the wage and salary share of corporate gross value added has gone up more quickly than we expected over the last 5 years with the revised numbers. So you are starting to see kind of more traditional margin compression coming out of this the business cycle where we are. So it actually pushed some of these recession risk indicators a little higher because you are starting to see labour scarcity being reflected in the price of labour, which is good for top line but not necessarily good for profits. And then the other question about the Fed, the Fed has already decided not only that it's probably in a rate cutting cycle, but also that it's going to end its buyback, running down its balance sheet, and is actually going to be in the business again of starting to buy bonds. And of course, we could get into a situation over the next few years where it has to start buying bonds again when the Fed funds rate approaches the lower bound. The problem with that right now is if you look at trajectories for US debt, which is $1 trillion budget deficits plus over the next 10 years or so, that could get even worse if we go into recession. There's going to be a lot of supply out there as well. So I think there are legitimate concerns not only here but abroad where the European Central Bank with negative rates is already talking about having to do more with rates starting negative, and same with Japan, that we are in a kind of constrained environment for what policy can do to generate much economic growth.
And if you think about, we are starting at such a low level now, and when the next crisis comes, say if we get into negative yield territory for the U.S. as well, and again go back to my point, think about how capitalism works. At least in theory, capitalism does not work well when capital is free, let alone when capital is negative. Not only free, you have to pay the bank to take your money, to deposit your money. And if, again, you think about the banks as the intermediary of facilitating capital flow and credit creation, so if, say, the yield become negative, they take our deposit as a negative yield, they'll be okay, right? But they will not lend any money, because the more they lend, the more they lose. So in that case, in that scenario, how capitalism really works, we don't know. So again, back to Mr. Miller's question again, if that happens, we will be in uncharted territory. At least all the risks longer term, even though we haven't seen it yet, but just recently we see a German bond, 30-year bond nominal yield is negative now. So we have to prepare, again, back to Ms. Middleton's question, we have to think about all these scenarios. At least on the slide, you see the historical scenario, we stress test ourselves, but these are hypothetical future scenario. It's not just a possibility, it may become a probability. So we have to prepare ourselves for all the different scenarios as well. But again, on the slide here, when we say we're trying to prepare ourselves better for the next drawdown, when this happens, we will not be immune from it. We'll still take a hit in the portfolio. But what we're trying to do is that we take a lesser extent of the hit, and more importantly, we can survive the downturn. And then on top of that, we still have additional liquidity on demand that we can deploy to take advantage of market dislocation during the next downturn. That's what we call the thrive part. So we have to survive first and then thrive. So that's the plan. But I don't want to give you an impression that when the next downturn comes, we have been working on all the, we are firing on all cylinders to prepare ourselves, and then will be no impact on us. That's absolutely not the case. So we won't be immune from this, but we'll be in a better position than what we were 10 years ago.
Yeah, thanks very much. A very helpful discussion, and just not a question, but just a little food for thought when it comes to the Phillips curve and the industrial economy in the U.S. worldwide. You might consider that the effect of the diminished role that organized labor has played in those marketplaces as a factor that's quite different from the effect in the service sector. So, thank you.
Yep.
Ms. Middleton.
Okay. Wanted to dig into the economic growth on housing. Question, is the trend national, or are there significant regional differences? And very specifically, how much is the downturn in the housing market in California contributing to these national numbers?
It's harder to get a breakdown in terms of residential construction, that big number in the aggregate within gross domestic product, but I can certainly look at where that's coming from. If you look at housing starts, that has tended to be fairly broad-based in terms of steadying rather than the growth we had earlier on in the cycle. But I'll get back to you with something regional on where that slowdown in construction has come from.
Appreciate that. And thank you for your answers to Mr. Miller. I'm not sure if I feel better or not.
Mr. Jones.
Yeah, thank you, Mr. Chair. The historical equity market drawdowns, the implications of this. I know it's a chart later. Are you going to go over that chart to show what the implications of these drawdowns are? Or is this the appropriate time to look at that? Or are you going to go over that later?
Mr. Jones, we don't have that prepared for the meeting today, but we have done all the analysis, scenarios by scenario.
Oh, so the scenario chart later that shows what the scenario is and the portfolio return doesn't relate to this chart?
No, each of the scenario what happened in the past, and what we did is pretend our portfolio position today, and we apply back what the each of the historical events and see what's the impact on our portfolio. But the impact on our portfolio from each one of the historical scenarios, we don't have it today prepared. We have the number, we just don't have it here.
But I'm looking at something in attachment 2 and that's why I wanted to know if you were going to get to that chart. Attachment 2, page 3, and I was trying to understand if this ties to attachment 1,
Give us a
page
second.
12. Some of the same scenarios.
Yeah, I don't know if we can put this one up on the screen or not, but as Mr. Jones said, basically, it's one of the standard risk management summaries that get printed out, and literally what you see on this chart, and I think this is page 3 of 9, is that the one you're looking at, Mr. Jones, with the horizontal lines, and everything is basically, for the most part, moving to the left of the 0 line, which implies, obviously, a significant drawdown if any of these situations plays itself out. As Ben said, we use these scenarios to hypothesize what would it actually take in order to try to maintain the target risk profile in the fund. Because ultimately, risk management for CalPERS is to be able to maintain what we believe is the appropriate risk profile as evidenced through the structure of the strategic asset allocation. So how much money, for example, if you had the tech crash repeat itself and you're looking at a drawdown in the 20%, 22% range, for example, that's the 4th one down the page, what would it take to basically be able to put 50% of the money back into public equities, because the public equity portfolio would have declined pretty significantly relative to other parts of the portfolio. So as Ben said, we look at these numbers and we hypothesize how much liquidity would have to be generated in order to reestablish the risk profile flowing or deriving from one of these kinds of events. And you can see, for example, even the financial crisis in 2008 and 9 was an even bigger drawdown. I think we're fairly confident that if these scenarios were to repeat themselves, that we would basically be able to maintain the risk profile. The damage that was done to the fund in particularly the financial crisis was in other words, there was enough capital commitments and contingent liabilities that it was unclear whether or not we would be able to satisfy those contingent liabilities, and therefore we actually reduced the risk in the portfolio and we raised probably excess cash. And that excess cash then created an opportunity cost to when the market started to rebound after that. The lesson that we've learned from that is that, one, we've changed the entire picture of those contingent liabilities. So, for example, the security lending portfolio going into the market crash in 2008 represented almost $40 billion of exposure. The security lending portfolio today represents about $15 billion of exposure. So it's about a third the size of what it was at that point in time. Same thing with capital commitments to the private asset classes. We had approximately another $40 to $50 billion of capital commitments. That number is now approximately half that. So those changes, and also the changes in the actual cash investment pools and buckets and categories, give us a lot more confidence that we have adequate liquidity to reestablish the risk profile given any of these kinds of scenarios. But the reality of this is going to be that whatever happens in the marketplace, it's not going to be the same thing as exactly one of these things. Right. So all this stuff gives us indications of what we might think we can do. We're going to have to see exactly how it actually ultimately plays out. But that's what Ben says. We basically go through these exercises of replaying these kinds of events, saying, okay, here's the effect, here's what it's done to the asset allocation, where are we going to find liquidity in the marketplace to kind of reestablish the risk profile or maintain it. And that is ultimately, at least in my own personal opinion, what risk management means to CalPERS, is being able to maintain the strategic asset allocation almost irrespective of what's happening in the market environment. Because we've determined that's the risk allocation that we think we like on a long-term basis. We now have to maintain that. I don't know if that directly answers your question.
Thanks for clarifying that for me. I was going down the wrong path. Okay, thank you.
All right. Seeing no other requests, I have one from the audience. Mr. Darby. Please identify yourself for the record, and you'll have up to 3 minutes for your comments.
Good morning, Mr. Chair, board members. Al Darby, President, Retired Public Employees Association. About a year ago, an imbalance was identified in a Wilshire report between U.S. Public equities and non-U.S. stocks. In other words, the PERF had an imbalance far too much in the non-U.S. stocks. The report showed the U.S. stocks outperformed non-U.S. stocks in 2018-19. Wilshire showed heavy U.S. concentration in those non-U.S. stocks. If the imbalance in the PERF hasn't been corrected, the PERF underperformed in 2018-2019 pretty significantly, because 50% of the PERF is in equities. Can you please inform us on this issue? The reports today don't indicate a difference, or they don't indicate the commitment to non-U.S. stocks and U.S. stocks.
Anybody?
Can somebody inform us? Thank you.
We're looking for the chairman's direction.
You know, if you have the information, let's share it. If not, let's bring it back next month.
Yeah, we'll bring that information back to you in a report that shows the mix between U.S. and non-U.S. equity investing.
Very good. Thank you. Ms. Brown?
That was my comment. Could we please answer his question? Thank you.
All right. Seeing nothing else on this item, correct? All right. Before we move on to the next item, it's time to take a break for the court reporter, so we'll reconvene at 11:20.